In the equity quadrant, taking a look at a rally that's paused in the December S&P 500 future. The S&P was the best performing index for most of the day today amongst the big four on a day when stocks struggled. All four major U.S. indices spent a lot of time in the red today, but on slightly below average volume and without a substantial change on the day percentage at all. As a matter of fact, the S&P was up a third on the high and down a third of a percent on the low. 59.91.75 the low, 60.35.25 was the high. That was up about a third of 1%. With a little bit of time left in the session, we're basically sitting at the flat line, down 2 basis points. I'm going to go ahead and call today unchanged because in either direction it's such a small move, but we either have a second consecutive day lower if the final closing bell shows us negative, or we'll have 5 days higher in the last 6 for the S&P 500 if we close slightly positive. Either way, today is not significant from a change on the day perspective. Now, sector performance, when you look at the sector breakdown, you can tell why the S&P was flat most of the day. The heaviest weighting in the S&P 500 is information technology, and that particular sector, while it was negative, was the best house on a bad block, down only 0.06%. Healthcare was the third highest weighting in the S&P, and that was the next worst performer. But the worst performers were utilities and the communication services sector. They're much lower on the weightings list for the S&P 500. Consumer discretionary, financials, and the energy sector were all positive, along with industrials and consumer staples, and those are pretty well represented in the S&P. We also had Treasury yields drop after the CPI, but they came back, throughout the day. CPI came in as expected across the board, but the Fed's favorite metric, the super core CPI, which is ex-housing, ex-energy, remained well above 3% at 4.6%. The FOMC prefers this metric because it's their belief that gives better insight into the labor markets. Well, as the day went on, we saw yields move higher on the back end of the yield curve, which could be a little bit of an inflationary signal from the bond markets, which pushes on the equity markets.